Banwat, Executive Director, National Security Depository Limited. We have Mr. Yogesh Kundani, Senior Vice President, Central Depository Service India Limited. We also have Mr. Vikram Dhawan, Fund Manager, Nippon Life India Asset Management Limited, joining us virtually. I present a very warm welcome to all of you. Can I please have a round of applause? I would request Mr. Sandeep Bhardwaj to please proceed with the session. Thank you very much.
Thank you. Good afternoon. I think this panel is in between the lunch and a lot of people must be feeling hungry, but in the interest of the objective and the subject, I will try to make it more concise and more insightful. So since morning, we discussed about mutual fund, how numbers have grown. Mutual fund AUM growth in last 10 years have grown from 8.25 lakh crore to 41.61 lakh crore. Number of folios in last 10 years have moved from 4 crore to 14.5 lakh crore, which is a 3.5 time jump. Monthly SIP, which was 6,690 crore in 2018, have seen 2 time growth and reached to 14,000 crore. MF penetration to GDP, which was 2013 was 7%, has moved to 16%. And believe you me, these numbers would have not been possible without the digitalization, without the impact of digital. But at the same time, digital also throws certain challenges. We have seen phenomenal growth, but how we can take it from here? For that, I have eminent speakers with me. They have a rich experience, and I'm sure their experience will value add to discuss and dwell upon these key areas. So my question to Yogesh and Samar are this, that particularly I come from brokerage industry, and we have seen that brokerage industry, even for that matter, financial industry has transformed a lot. And more than finance, it has become technology industry. Now, largely we see that most of our customers trade digitally. They trade online. So how has technology influenced MF industry so far, and how you see that this trend, is going ahead?
Sure. Thank you, Sandeep. See, today what has happened is, we are at that stage where the mutual fund industry and the penetration of mutual fund is still very, very low as compared to what we want to reach. Now, if you want to reach to the masses, the only way is to have technology enable the entire distribution network in such a way that you are able to reach to the masses and people are able to actually invest at a click of a button, and it is very easy, simple to invest. So, as Sandeep was mentioning, what is important is, of course, execution is one part. But, more important than the execution is the ability to decide, what do I buy? So, that is not so easy, because financial services per se, for people who really don't understand, so what is more important is how do we enable technology to provide financial education to people and then provide execution services so that they have education, they understand what they want to do, and then we provide execution platforms. So for both, technology innovation is the key, and that is the only way we can actually deliver this service at a low fee for scale. It's always possible to put people, but then there's a cost. It's only with technology that you can actually distribute your financial services and reach the masses, and still the distributor is able to make money, enough money to sustain so that he is able to do more.
I think very, well point. Hello. Yeah. So you rightly said, technology has made execution DIY, but the technology role is to make decision-making DIY. Till the time, if we need to penetrate mutual fund to every nook and corner and make it accessible to every investor, the decision-making has to be DIY. So I'll take the same questions to you, Yogesh, that, if you can just enlighten.
Yeah, very good afternoon. Would like to thank ASSOCHAM and Sandeep Bharadwaj for this session. I agree with what Mr. Samar Banwat said regarding the technology. 2 points which I wanted to add to what Samar Banwat said is that, taking it to the masses to some extent, during COVID time we had got good support from the regulator SEBI, wherein, online eKYC was enabled in HDFC Securities also you have been using it extensively, which has led to the, the fillip of, new investors coming into the markets, investing in, of course, both. Once they open their demat accounts, they can invest in both in mutual funds as well as in the stock market. Benefits of demat in case of mutual funds, Samar Banwat has already covered in the inaugural session. I would not like to repeat it due to the time constraints. But the online KYC is, one of the most cost-effective ways of reaching out to the masses and getting in, new investors. Second part of the distribution, which I feel to some extent has not been exploited, which I feel is through the stock exchange platform also. So stock exchanges, which is the NSE and BSE, has got a very good mutual fund platform. Lot of brokerage houses, almost all leading brokerage houses are members of the stock exchange platform. And stock exchange and DPs in turn have got presence in more than 20,000 locations across the country. CDSL, NSDL both put together, we have presence of depository participants reaching out to more than 20,000 locations across the country. Third part which I would like to stress here is that to increase the penetration of mutual funds, the question which you asked is, both CDSL and NSDL, we along with the regulator SEBI and stock exchanges, we have now been focusing on doing awareness in tier 3, tier 4 towns, where the penetration of mutual funds or, demat accounts, stock exchange, trading accounts is not much. And we have got good success in the last 1.5, 2 years. See, in COVID, also we did not stop awareness. We started using digital media, which is webinars. Through webinars, we tried to reach out to the investors across the country. Of course, there were limitations that time because of the prevalent COVID situation. But as soon as COVID was relaxed, we have been focusing on doing a lot of investor awareness programs. We do, in CDSL, we do close to 3,000 programs every year. We plan to, increase this much further, along with SEBI and stock exchanges. And as the awareness levels will increase, I am sure the penetration of mutual funds will also, subsequently increase. So this is good.
We'll take your question and answers, in the interest of time, let us complete that, then we'll have the Q&A also. For making an investment in mutual fund, the most important thing is KYC. And it is more and more talked about the complexity of the KYC. Though the industry has come a long way. But do you see it is getting more simpler for a customer to make investment in mutual fund by doing simpler KYC or one-click KYC?
This has been a significant ask of the entire industry because, when somebody, see, I'll tell you, now look at UPI, okay, the payments industry. It has reached the nook and corner of the country. Anywhere you go, a small vegetable vendor, you are able to make payment through UPI. And it is very easy, simple. Now, whether it is possible to sell mutual fund to that extent and whether investors can buy directly, well, there is a problem over there. What happens is, if you are selling any good or service, which is any vegetable or something, you don't need a license to sell that. But when you are selling financial service products, you need to have a license, otherwise there is a huge risk of mis-selling. So that is why, if you want to really penetrate the entire market, and really reach the masses and scale, it is extremely important that we simplify the process of onboarding a customer. And this onboarding a customer, then the customer gets onboarded, then you invest. It is all, a little archaic. What should actually happen is, if I have money, I am transferring money, the money should get invested. That is what should happen, and technology has the capability. And now people are actually building journeys to really service them, and I think this is just a time, and as we go along, things are going to improve significantly. In fact, there was a budget announcement by the finance minister, and the thought actually was that if I have a PAN number, I should be able to invest. But of course, this is some time away, but these are things which will happen.
So as industry has already moved where through bank account, PAN numbers and Aadhaar number, everything is getting linked. We are on the corner of, and it's become possible. But your view here on the KYC front?
Yeah, so I agree with what Samar just said. To make the journey, the digital journey simpler, we are looking at, for the KYC part, we already have a, API, wherein a lot of, the new fintech players have integrated it in their digital onboarding journey. Lot of full-scale brokerage houses have also now adopted technology and are integrating APIs of, both the KRS, CDSL and the NSDL KRS to make the journey much more simpler. So yes, it will become much simpler as we go forward, and we'll hope for the best. Let's hope for the best here. Thank you.
So we've seen, AI is the most talked about word, and everyone is using AI in some other extent. And we have seen AI driven by the LLMs taking the world by its storm. The most recent Google AI has scored greater than 86% in the US MLE-like exam. So how do you see AI changing the MF industry for digitization, documentation, delivery, distribution or advisory? Where you see that it can be more effective and can be helpful for retail investors?
See, if you look at artificial intelligence, one immediate use case, which really is something which a lot of people are actually adopting and really thinking of and really rolling it out, is investor service levels. Okay, so if he has some query, okay, how do I do this? Okay, do this. If I have any other type of query, it is very easy and simpler to really use AI and provide service using technology and giving the right guidance. Now, this is something which I think people have already started implementing. It's the success is not really very high. People are really experiencing it. It is making sense, but we've not reached there so far. But I think things will improve because it's kind of self-learning and it will improve more. The second important thing which artificial intelligence can do is actually help in product suitability for a client profile. So this is something which is what AI can really help and help the investor really make the right decision to invest when, where, what. So that is where a lot of, not only in India but even around the world, there is something known as a robo-advisory, which is what a lot of people are working on. We've not really seen anything which is really live, but I'm sure these things will come to India also.
Thank you. Yogesh, your view on this?
Yeah, so you are correct, Samar. What he said was that, AI can help in advisory. But there are, few investors who would like to have a tailor-made advice to them, which would be suitable to their needs. Because, in financial planning, there's talk that, every individual is different and every individual needs a tailor-made advice. So, just by AI coming in, I don't feel the role of advisors will, completely go away. Especially the SEBI registered investment advisors, because they offer a tailor-made advice which is suitable to a particular person's family's needs. Okay, we need to see how AI can actually, be taken forward in case of advisory at least. The other things, of course, in terms of distribution, in terms of, onboarding and all, of course, AI can definitely help, which we covered earlier.
So I would like to add something on
here,
AI.
and other than that, what I can add on here is it can make entire experience hyper-personalized. You feel that basis your risk profile, all the options which has been suggested, the journeys and the execution can be aligned to your persona. So that's where it can be achieved by AI. But as you rightly said, the role of advisor, the role of guidance doesn't go away. If financial inclusion has to happen, if a common retail investor has to understand where where one has to invest money, the role of advisor comes into the picture for authentic advice. I think coming back to the cyber security, today the data theft are a common news. Every day we listen about some of the other companies being attacked by the cyber attacks. So what is being done in the MF industry? Both of you have spent good time here and manage entire data, being NSDL and CDSL. What is being done in the MS industry or to stay ahead in the cyber security frame, given the nature of the data is very sensitive and it carries the entire financial and personal information about the investors?
Yeah, so very good question actually. Cyber security, of course, is very important considering the number of digital transactions which have gone up since COVID. The steps that we've taken is at least in the depository industry, this is very unique in the sense that the transactions is happening B2C, that is the broker or the DP is interacting with the customer, the demat account holder. But in terms of, like off-market transactions which happen, or, in case of EDIS transactions, which is the digital transactions which are being enabled and it's picking up, there the customer actually is coming on the website of the depositories, CDSL and NSDL. OTP goes from the depository directly on the registered mobile number of the investor, and the investor has to himself or herself authenticate on the depository's website, be it CDSL or NSDL. So this is an additional security layer which has been, inbuilt, apart from, the normal two-factor authentication, password and all these which were already there prevalent. So these are, one additional step which we have taken to increase the, the resilience and the cyber, threat which is there in the depository system.
I think great initiatives. Today, the largest challenge for any organization, any regulator is the cyber security. And most of the organizations are doing adequate actions to prevent the customer's sensitive information. My question to Jayant, to you is, today financial planning is a key component behind investments. Everyone talks about financial planning. But after all, it is important to be aware in the investments are adequately contributing towards the life goals. However, so far financial planning has been available only to the well-heeled investors, maybe the top masses or the top funnel of the customers. We know today the 86% of the MF investors are actually retail investors, and the SIP amount is less than 2,000 per month per folio. So how can we ensure that financial planning reaches to these investors?
Okay. Hello. So I'll answer this question with slightly 30 seconds extra. So there are a lot of youngsters sitting here. So I'll just ask a simple question. How many of you want to become wealthy and richer? Can they raise their hands? Now the second question is, how many wants to become rich in a day, in a month, and in a couple of years? Day, month, years. Sorry, couple of months you want to become richer. Okay. From that side? Thank you. So the problem is, everybody wants to become rich, but nobody wants to follow a process. Everybody knows the name of Warren Buffett, Rakesh Jhunjhunwala, etc., etc., but nobody wants to follow the path which they have, followed for 25 years, 30 years, 50 years, 60 years. There was this presentation, I think 15 minutes back, about the power of compounding, right? So, Mr. Warren Buffett, biggest 80% of the wealth got created only when he became 65. In spite of the fact that he started investing from the age of 15. Got it? Unfortunately, abhi India mein kya hua hai, particularly after COVID, I think Sandeep can vouch that, the number of demat account which got opened, number of people who are active in F&O, and the number of people who are active in, not even in F&O, options. you know what is the daily turnover of National Stock Exchange in options? A wild guess? If you actually take the premium into, because if you buy a premium, there is somebody who is selling a premium. Somebody who sells a premium, it is taken as a contract value. The daily volume of National Stock Exchange in F&O is 300 lakh crore if it is considered as a contract value. 300 lakh crore. Imagine how many of the people who wants to become rich is actually participating and actually losing money. Number two, there was this latest data by SEBI and exchange where they have officially declared that 90% of the people who are participating in F&O are actually losing money. In spite of the fact, there are people who wants to become wealthy and become richer within no time. Now answering Sandeep's question that why an SIP value is only 2,000 rupees and it's not increasing. First, you need to understand SIP is a compulsive way of parting some income which you are otherwise, you would have spent. Let's assume if your salary is, example, 50,000 and you are saying that I am investing in SIP only 2,000 rupees and you are spending the balance 48,000 rupees in other essential. Suppose your salary becomes 1 lakh and you are still investing 2,000 rupees or 4,000 rupees is actually a crime. It's a crime. Number two, which is even a bigger data point is 95% of the wealthier people in the world, 95% of the wealthier people in the world have actually made money investing in equities. Not through options, not through futures. Investing passively into equities, giving time for that equity to mature. So obviously, if you want to become wealthy, you want to become rich, you have to have certain process to follow, certain discipline to follow, and you have to make sure there is a compulsive investment which goes and which keeps on rising, and you give the power of compounding some time. Power of compounding doesn't happen for months, it doesn't happen for days. You have to give some years. I hope this answer is...
Well articulated, Jayan, there. To take the question forward, in fact, we also have Mr. Vikram Dhawan with us through video call. So, Mr. Dhawan, first of all, welcome. And if I would request if you would like to add on the same question. My question was on financial planning and how we can help customers. I think most of you here, sitting here, must be surprised to know that since 20 years, last 20 years, the sales and the investor or advisor pitches 2,000 rupees per SIP. And I've seen most of the customer ending up buying the 2,000 SIP only, in spite their allocation can be much larger in that. And that also is a primary reason they lose interest. Because the asset which they see, that the ad which they might have seen, they become crorepati. But the allocation in the SIP amount is nowhere is helping them to become crorepati. Yeah, Mr. Vikram, over to you.
So thank you very much for inviting me on the show. And apologies, I could not be in person, but I think it is appropriate that on a digital discussion on digitalization, somebody should be online. This shows that how far we have come in technology as far as digitalization of the country is concerned. So before I answer your question, very briefly, I would like to quickly mention what worked and what did not work for the mutual fund industry as far as the technology is concerned. And also, what is the difference between a tech company and a mutual fund which is using technology? So, I see, or rather I hear from you, a lot of young people are sitting over there, so they may have this question in mind. So typically, tech companies is a company where the business is built around the technology, whereas, companies which are using the, technology solution, they are the users and the technology is built around the business. So, as the technology is expanding rapidly and, there is, the users of technology are catching up, and it is also tribute to the technology companies of, making technologies more, accessible by the masses and more easy to use. The technology arbitrage between, let us say, a user of technology like a mutual fund or a pure-blooded, a tech firm, the technology arbitrage sort of coming down. I mean, just to give you an example, the experience any investor would have while buying, a mutual fund or, any fund on a AMC or a mutual funds app or a gold fund or a silver fund will be quite similar or, comparable or if not better than, going through a fintech sort of a platform. So that is something which has worked for the mutual fund. They have been able to up their games as far as the customer experience is concerned. The second important point is the fidelity issue. Now, technology companies typically are very jealously, guard the fidelity of their technology and the process. Now, in case of mutual funds, since we are regulated by SEBI and it is a very well regulated, I don't want to use the word heavily regulated, but yes, in some ways it is we are one of the strictest regulated markets in the world as far as mutual funds are concerned. Which means that not only mutual funds have to focus on the fidelity of the process, they also have to focus on the fidelity of the product. I mean, if you are buying a fund from any mutual fund, the scheme information document, the fund casing and all has to be consistent, and the AMCs are answerable for that. I mean, if you are buying a large cap fund, it will only be large cap. If you're buying a silver fund, it's going to be only silver, and a gold fund, as the case may be. So that is as far as the fidelity is concerned. The mutual funds have used the technology as an amplifier of this attribute, and which is being appreciated by the people. Also, last but not the least, and this is something which is not very well articulated, is that as mutual funds, not only what we do is regulated, it is also what we communicate and what we tell our investors, that is also subject to regulations and scrutiny. So that is why whatever apps that you are frequenting of any mutual fund or any websites you are frequenting, you have to be assured any information, any data which is available over there has gone through the rigorous process of compliance and risk analysis. So that is also one thing which gives a lot of comfort to the investors, and that is one of the reasons that the mutual funds through digitization have been able to penetrate so well. Obviously, it is still we are still talking about 3-4 crores of folios, unique folios in the industry. So still a long way to go. Now, coming to your question, I think for the youth, it's very important to understand that when you talk about capital markets, when you talk about mutual funds, when you talk about equity, debt, or commodity, or gold, or something, it's very important to take a step back and understand that you are good at something. You may be an engineer or a doctor or a lawyer. You are good at something, but maybe there are certain businesses, there are certain processes that you understand in the industries, various industries. So one way is to probably see somebody doing it in your field and getting rich and you applauding it. The other way is you participate in that industry. Suppose if you're very you like the EV electric vehicle story, or you like the tech story, or whatever story, the commodities boom or whatever it is, and that is something you understand and you want to participate. The stock markets, the capital markets, the bonds, the equities, and the funds, types of funds are a way of participating into that and investing into that. So while we have all talked about returns, we have all talked about hard data and numbers, but there has to be some sort of a spiritual, emotional, whatever you want to call it, connect with your investments. Don't just buy because it's in vogue. Everybody is buying it. I mean, as they say, it's never safe to drive a car by looking in the rear view window. So have opinions. You will go wrong. But again, there are these markets are very forgiving. There are a lot of products available. If you can't decide, there are hybrid products, there are multi-asset products, there are various asset classes that you can use. So I think this is something should be the starting point. Once an investor is clear on the objective, then the second part becomes easy on what returns to expect, what is my nature, what is my risk taking ability, what is my loss taking ability, what are my aspirations, that comes second. So I think wherever I've gone, whenever I've talked to investors, this is something which is very undersold. That what is my objective? Why am I putting money in the markets? Why am I not putting it in Bitcoin, or why not Dream 11 or something like that? So that is something that you have to be very clear on the philosophy, the objectives and the philosophy. And that is the common thread of every organization and every individual who has been successful. Their objectives and philosophies have been very uncluttered and very clear. So I think I'll take a pause over here because I think it's we are between the
very
lunch
well explained,
and,
Mr. Vikram, very well explained. And I just add up one point here is that all investments has to be attached to the goal. If these investments are attached to goal, it is goal-based investments. It can have a right time frame, and it get impact of compounding as well. So you get a right expected returns. If without a goal, investments can lead to disastrous expectation of returns as well as outcome. So my suggestions are always, whenever I go to any investor awareness program, I always suggest try to attach your investments to goals. That is the best way to be more disciplined and to be more regulated. Coming back to two important points. One is how to make investor more aware about the investment opportunities, mutual fund, and how to protect mis-selling. I think there's two large issues which industry has to address if the penetration has to reach beyond where we stand today. So I want to listen from all four of you here that what is your take on this? And in fact, to add, it is a very nice panel where we have DPs, we have AMC, we have distributor. So I think all of us plays a different role here. So what's your take on that?
Since this is a technology panel, technological innovation, so let me talk about financial education from a technology innovation perspective. So NSDL, of course, one of the most important thing is, there is a lack of awareness, and we want to reach the masses, and unless and until the person is not told कि भाई यहाँ पैसा डाल दो आपको फायदा होगा, nobody is going to put money. Somebody has to tell them. Nobody is going to suddenly wake up one day and say, okay, I want to invest. Somebody has to go and tell and explain, and so that he understands and is able to invest money. So what is really important is that the entire, the distribution network, the AMCs, the depositories, the exchanges, everybody has to reach out to the investors and to really educate them and to make them more aware about, why they need to really invest and why it is better for them and why it is for their own good sake. So at NSDL, I'll tell you a little thing which we did. At NSDL, for the last 25 years, we have been doing investor seminars. Recently, about a year ago, after the COVID struck, we came up with a new concept, that is Market Ka Eklavya. So this was launched by the Honorable Finance Minister, Shri Nirmala Sitharaman, at the Silver Jubilee function of NSDL. It is an online course of 3 hours where we conducted a knowledge session where we talk, about financial education in very, very, very simple terms which people can relate to. So talking to them in their language which they understand, and then tell them about financial education after, so that we take them along with us so that they exactly understand what are we talking about. So here we have targeted especially college students all across the country, and this is a completely online course. So the college students are sitting in a classroom in that setting, and we are giving this education from our place, and this goes on for 3 hours, and it is about sensitizing them about financial planning and to manage their money for their own good, for their future. In less than a year, NSDL was able to do 260 Market Ka Eklavya sessions, and we were able to reach out to 16,000 students. So this was the power. And what we also observed, that of the students, 50% plus were women or girls. So students were from various streams: commerce, engineering, pharmacy, medical, and we were also able to reach out to the 7 sister states, J&K. We were able to reach out everywhere simply because it was online. And of course, we had to reach them, and finally at the end of the session, we gave them a certificate which is by Michigan Academy of Developing Entrepreneurs made, and NSDL is a certificate given to them. So, but let me tell you this, once we did it now, if you just go through any one session and you talk to one of them, and the kind of regard and gratitude which they show that, okay, oh, thank you so much that you told us this, and now we know what we need to do. And then of course they will take their own journey and this will stay with them for their life. So this is the kind of impact we are able to actually create. And so my request to all of you is, being in this space is to really spread the word and educate people about financial education. So that's all.
Hello. So just taking forward from what Sandeep said, first thing we need to understand in financial market, everybody is investing their own money. They are not investing somebody else's money. Today we do hundreds of research before buying a mobile, before we buy a consumer durable or an AC. कि ये 3 टन का AC 32,000 का है तो 4 टन का AC कितने का होगा वगैरह वगैरह. But when we invest our 50,000, 1 lakh, 5 lakh or whatever, we don't even think or do a simple research of where we are going to invest, how we are going to invest, what is the credential of the financial advisor who is even advising you to invest. And today, frankly speaking, we are in a digital era where everything is available on a click of a button. Every piece of information is available on a click of a button. I think if you are losing money by ignorance, it's not anybody else's fault, it's your fault. Number two, I think youngsters would have seen a web series called Jamtada. How many people have seen Jamtada? You know what happens in Jamtada? That somebody calls you up, asks for a PIN number, token number and takes away 50,000, 1 lakh rupees. Will you allow that to happen in a normal course? I can understand out of ignorance a senior citizen gives a PIN or something like that. But somebody who just calls you up and asks for a PIN or somebody tells you invest 1 lakh rupees in, will you do it? You will not. So as far as investor education is concerned, I think regulators, market providers, everybody is doing their best to give a piece of information to you. But as an investor, if we are not taking the hands and taking that information and absorbing it, I don't think we can blame anybody else. It is us who have to be blamed. And frankly speaking, whether you are investing in a real estate, whether you are investing in financial markets, insurance or anything, you will always find some scrupulous people. There will be some mis-selling happening, but you can't get away. It is your job how you take this with a pinch of salt, whether generating a 15% return annualized is easy or it's difficult. I think I said it all.
Yeah, so I echo their sentiments. We also in CDSL, last financial year which went by, we did more than 1,500 programs. Most of them, in fact, 2/3 of them were in the tier 2, 3 and 4 towns rather than in the tier 1 towns. This year also we plan to do more than 2,000 programs across the country. Many of these programs we do along with SEBI, with stock exchanges also. In the model presentation which SEBI is also given, there is extensive coverage on mutual funds, how mutual funds can be used by a normal retail investor spread across the country for meeting their short-term, medium-term as well as long-term goals. So we cover this extensively in detail regarding mutual funds, ETFs, how ETFs can be a part of the overall portfolio of the retail investor, and how they can use mutual funds for meeting their life goals. So this is being done and we are getting excellent response. You can see from the success of the mutual fund Sahi Hai campaign also, which AMFI has been doing for the last several years. So as the awareness levels improve, education levels improve, financialization of savings is gradually happening on the ground. And it is evident from the number of SIPs that has been growing month on month, and the maturity of the investor also. The investors who have been investing in mutual funds for the last 5-6 years, they are not panicking now as was evident in the previous years. So this is because of the awareness, the education, the hand-holding done by the SEBI registered financial advisors So I'm again coming back to that point that role of the advisor is extremely crucial and important in this. Along with, of course, MIIs, we would be, of course, always be involved in this financial awareness and education for increasing the literacy levels across the country. Thank you.
I'll just add.
So I have a slightly different take on this, if I may, add.
Yeah, Vikramji, please. Yeah.
So, I slightly disagree with all of you. Because, we tell our families, we tell our friends, we tell our kids to eat healthy, and it's Friday evening, let's see how many of us end up eating healthy today. So we know what is good for us. I don't think it is purely education. It is also the philosophies. It is also the role models. It is also what is being celebrated in the social media and the main media, which really, sort of affects the masses. So I think that is something, these are softer issues, but fact of the matter is that, the popularity of any fund or any asset class is at the highest when it is doing well. That is the human nature. And talking about education, somebody mentioned a very good statistics in the one of the previous discussions that ETFs have gone from some 1 or 2% of the AUM to some 17-18% of the AUM. But I'm surprised when I do manage a couple of ETFs also along with Active. I'm surprised whenever I am speaking to all investors across all cross sections. Not many people are aware that why ETFs have become popular. They only talk about the cost, but I think one thing which is perhaps not well articulated or not well understood is that it's like if you talk about gold ETF, you can buy 1 gram worth of gold ETF and sell 1 gram worth of gold ETF at a very minimal impact cost. Whereas if you buy the same in the physical market, the impact cost would be very, very high. Same for stock ETF, same for bond ETF, selling one bond from the other. So, these are the nuances and these are the issues which still, I think, it is still work in progress. I am not taking away anything from the initiative by AMFI or all the gentlemen who are sitting over there. But I think we do get to do the dipstick test because we go and meet the, we have interaction with investors on various forums. So I think it is still work in progress. Also, I think, the information dissemination or knowledge and dissemination has to be at various levels. At the product level on what the product can do, that is very important. Because people usually get muddled that, equity fund has an equity fund XI over. Again, quoting what, somebody mentioned that in the same asset class, you could have fund, deviations of as high as 30-40%. So I think that is something, a little bit of drilling down on that is concerned, on the underlying itself is concerned. Also, I think we sometimes tend to keep the uncomfortable truths and question on the disclaimers. And I think that is one thing which perhaps I learned very early in life, that if somebody, your investment appetite is proportional to your risk appetite, not the other way around. So I think, these kind of things, these are softer issues and they are not easy to frame. But I think forums like this and, the social media platform or the media platform, we need to have more discussions on, there are no free lunches in this world. If you want to make a lot of money, you will have to take risks. And if you want a steadier compounded return, the risk of your portfolio has to come down, diversified portfolio, etc. So I think this is something which is still work in process. And for me, it is more of a philosophical issue right now, issues of philosophy on aligning the investors to philosophies and knowing what philosophies they belong. Maybe they don't even belong to mutual fund. Of all they're looking for 40% returns every year. They don't even belong to our asset class. So maybe we are all wasting their time on us. Or they're too conservative who can't even lose 2% on their portfolio. So I think this kind of screening we somehow need to have, a questionnaire, maybe an AI can help into it. It can be part of the KYC. I'll just give you an example. I started my career in London working in the London Metal Exchange, and I think first thing they used to do is fill up the form from every customer, whether an institution or an individual, on the level of sophistication of knowledge of, and they had to actually answer questions to assess that how sophisticated the. Yeah. So we have those, tests for the advisors. I think there should be some sort of a test or some sort of a screening for the investors also. Again, this is my personal view, nothing to do with the view of my organization or the industry.
Well said, Mr. Vikram. And as I earlier mentioned, it is all about your money. It's about your risk, persona, your risk profile. You know what kind of risk one can take, and what money needs to be allocated. The bare expectation of X percentage will not be achieved unless or until you are making a right investment decision. And one has said, investment is a journey to reach a right destination. For that, you have to define the destination, and you have to give journey to your investments. Mr. Vikram, just to take it forward, you touched upon ETF, and you represent, ETF space as well. And ETF has seen its own success in past few years, and it can be good product for consumers who don't want to choose multiple funds and they don't want to, take a risk. So ETF can be good. So I want your view here, how ETF can be part of retail customers' portfolio and how it can benefit them.
So I think ETFs, the reason why ETFs have become very popular over the years, and they have been a recent invention. I mean, the ETF invention is maybe 2-3 decades old, whereas the capital markets are more than 100 years old. So they have been a recent inventions, and they have been one of the finest inventions of the financial sector. And I think the 2-3 reasons why ETF have become very popular across the world is because of the cost. And there's a saying that when you buy an active fund versus an ETF, in active fund, if the fund manager outperforms, you get the gold medal. If it doesn't outperform, you get bronze or nothing. But in ETF, you're always assured of a silver medal because you're always, hugging the index and going. So, so I think that is one thing which sort of surety of returns, surety not on how much you will make in percentage, but you'll be very close to unless the fund manager really moves it up. If it is a Nifty index or if it's a Nifty ETF or a gold ETF, your returns will be almost mirroring the returns on Nifty and gold. So you don't have to take the risk on the fund manager risk per se. But also the other thing is that over a period of time, ETFs have infiltrated almost all these sectors and subsectors. You have ETF on commodities, you have ETFs on bonds, you have ETFs on, small caps, large caps. So there is a lot of options available. And, because of the critical mass, even India now has a good critical mass in ETFs. So there is, liquidity which is quite acceptable as far as investors are concerned. Also, I think last but not the least, what the ETFs have also done is, they have sort of, taken away the asset allocation headache. I mean, at the end of the day, more money is to be made by, by proper asset allocations than, allocating the security in the same asset. So, for instance, last year, let's say gold was the best performing, or maybe this year equity will be best performing. Suppose, hypothetically. So, and if you're not into equity, then no matter how much, whatever bond you select or whatever commodity you select, you will never be able to outperform the market. So I think ETF sort of offers you a very smooth and easy and convenient way of creating sort of a balanced portfolio. You can have various funds in various asset classes, and they need less monitoring, they are less costly. So I think these kind of things have really made ETFs very, very popular. But having said that, it is definitely not the end of the active play, because there are certain sectors, there are certain strategies which only active funds can manage. There are thematic funds, there are sectoral funds. There are also you have to understand that the construct of an ETF is very rigid. It is based on a sort of a pre-declared an algo or a formula, or it cannot be tampered with. If it's a Nifty ETF, it has to be, the basket has to reflect that Nifty ETF. They don't have the flexibility, whereas the active fund managers have the flexibility. And also, I think over a period of time, thanks to ETF, the active managers have also upped their games. And last but not the least, with ETFs coming into the market and becoming mainstream, and not so good for the mutual fund, but very good for the investors, the expense ratios have gone down, and they will continue to go down, which is very good news for the investors.
Thank you. I think quite insightful. You want to add? Yeah, please.
Actually, I have a question rather than answer. when there are passive funds, and in the US, the passive fund industry is significantly higher than what it is in India. And passive funds have been in India not for like 2 years, but they have been in India for last almost 15 years. But the kind of, penetration which the passive funds actually need to have, we really not even scratched the surface. And these are, very, very kind of a suitable product for any kind of an investor, where there is no fund manager who is taking a decision as to what to buy, what not to buy. It's already predetermined. So that cost goes away. So why, despite that, and with a very low cost thing, why do you think, we've not really, penetrated so much into the ETF space, where we could have easily gone much more than what we have done?
Mr. Vikram.
So I think one of the reasons is that you need a demat account for ETF, because you're buying it through the exchange. And secondly, you need a brokerage account as well, because unless you're a member of the exchange, you cannot buy them. So there is an element of brokerage. While the expense ratios may be less, but if you are a frequent, in and out, you're doing frequent in and outs, then I think it defeats the purpose. You may have a less expense ratio, but you will end up paying brokerages many times over. So, it is, yes, they are, and obviously, if you're a very, very long-term investor looking beyond 3, 5, 10 years, then yes, perhaps, and those are the people who have actually frequented the ETFs, if you really ask me. And as the data clearly mentioned, that the average shelf life of an investor in the equity markets in India is 2 years. So I think these are 2, 3 reasons why ETF has not been popular. Also, I think what will happen is, and what we are seeing in US also, and that is something which is very interesting happening. What the academics have researched and simulated, that once the size of the ETF market goes beyond a certain level, then they sort of hit, they start becoming inefficient in the sense, just to give you an example, if everybody stops buying active funds and buying Nifty ETF, then, in Nifty, not all 50 stocks deserve to be bought, right? So, those kind of inefficiencies also creep into the market. And typically, if you're a good, smart, active fund manager, you're looking at these, inefficiencies which the ETFs have created, and you would like to exploit it. So, both are actually cannibalizing each other. The ETFs want to prey on the inefficiencies of the active funds, and the active funds want to prey on the inefficiencies of the ETF. It's a battle going on there, trust me. I mean, whether it is within the organization or outside the organization, the ETF fund managers and active fund managers are rarely, I won't see many of them going out for drinks tonight together, which is a very healthy thing for the market. And I think which way the cookie crumbles, we don't know. But at the end of the day, I think it's a healthy competition. But yes, your point is well taken. But I think once the investors mature, and once you have structures like a fund of funds, or a multi-asset or hybrid funds become more popular. Again, that is also another problem. You talk about multi-asset funds or fund of funds with ETFs, they are hardly 2-3% of the total AUM. So I think that could be a growth area where because obviously fund of funds and multi-asset funds don't need demat accounts. So that could be another growth area that we would see going ahead. And I think the journey has already started.
My next question to Mr. Vikram and Jayant is, MFs have come a long way in the diversification of the product offerings, from hybrid funds, global ETF, FOF, ETFs, commodities. For a new investor, who wants to start his mutual fund journey, it becomes very difficult for him to choose the right investment once he sees that it's so many investment options within the mutual fund space. So what's your piece of advice here, for an investor who's starting their mutual fund journey?
Sure. So I think my personal philosophy is that every asset class needs a consideration. Every asset class has a long-term journey, long-term trajectory. Equities will have their own trajectories over a long period of time. Fixed income will also have it. Gold will also have it, and all the other sort of products available in the market. I mean, unless you have a crystal ball where you can predict which asset class will perform this year and put all the money over there. I don't have it. If anybody has it, then they're very lucky. But if you don't have it, then the best way to start in the market is to have diversified funds like hybrid funds, like balanced advantage funds or multi-asset funds. It does two things from them. One, obviously, they are able to participate in the long-term trajectory of all the asset classes. If this year, and if you see the data, historic data, every 2 to 4 years, the leadership changes. 2 to 3 years, equity will be in lead, then debt will be in the lead, then gold will be in the lead. So this passing the parcel keeps on happening. It has been happening for the past 20, 30 years since I've been in this market. And it has been very difficult to predict. I mean, people at the Federal Reserve have got things wrong. So who are we? We are just mere mortals with, maybe at best a magazine or at best a Bloomberg screen in front of them. So we should not have too much of, trust in our own capability. We should also be good listeners and also be humble when we approach this market. So once you are starting a journey with a multi-asset sort of a portfolio, then you're able to participate over a long term in all the asset classes. And the bonus thing is that just because there are negative correlation between these assets, even if there is a lot of volatility in one or two asset classes, the drawdown or the losses in your portfolio will be a lot lesser than the particular asset class which has gone down. And why that is important is because compounding, we all talk about compounding, that the best way to get rich is to do compounding. Now, compounding, obviously, in a portfolio which is volatile is very unpredictable, but compounding in a portfolio which is less volatile, and multi-asset funds tend to be a lot less volatile. I'm not saying put all your money in multi-asset funds. Do go and take calls. Do have views on sectors, caps, and asset classes. But I think it's a good starting point for investors to, as they say, to dip their toes at the market and then learn from the experiences and then build upon that.
Jayant?
Yeah. I'll just add what Mr. Vikram said. So every investment journey starts with a goal. Without knowing the goal, there is nothing called how to invest, where to invest, how long to invest. It's like if you are going from Delhi to Jaipur, you take a highway. You have a choice of driving your car at a 5th gear, or you have a choice of driving your car in the 1st gear itself and keep driving for 15 hours. So first you need to know whether you have to reach Jaipur by 5 hours or 6 hours, or you have to keep on driving. So every asset class has got a minimum time period which you have to give. Whether it's a gold, whether it's a debt, whether it's equity, and obviously you can't drive the same Ferrari car in a crowded market at a 5th gear. So you have to time it and you have to slow down sometime, bumper, etc. So needless to say, every individual who is investing, first question he is to ask is till how long this money is not required. Depends on that only risk is ascertained. Depends on that only you know which asset class to choose. And depends on that only you will actually know what returns you will make. Only because you have certain spare money for 6 months, you can't just put it in an equity or some gold for 6 months and later on repent. So everything starts with a goal. I think keep your goal in mind, keep your process in mind. I think everything can be achieved at the simplest form.
Thank you, Jayant. With this, I open the forum, and if you have any questions for any of our guests, please feel free to ask. Yep. We'll come to that.
Hi, I'm Ida from TV9. Actually, throughout the discussion, I saw that there's a lot of onus was placed on investors in terms of getting the right information and being actionable, take action on them. Since one of the agenda of this panel discussion is sustaining investors' trust in mutual fund and also about digitization, I wanted to understand, talking at the nexus of regulatory framework and corporate governance and technology. In the previous panels, it was mentioned that change is the only constant and the industry needs to mature. But since this panel has representatives from depositories and from AMCs as well, I wanted to understand a crucial aspect of building investor trust, and that is on the evolution of tackling front-running and insider trading practices within the AMCs. There have been a few cases in the past, and SEBI has recently made a proposal around it as well. So talking on this nexus, how do you see the evolution and self-surveillance also for both for these AMCs and for DPs as well to so that investors finally understand and get more trust and develop more trust in the industry that they are investing in. So what are your views on that?
Yeah, Mr. Vikram, you can take this question.
Yeah, sure, absolutely. That's a very valid question, and I think when we say regulated, what does it actually mean? The market has evolved, and I am not denying that, like every market, we have had our ups and downs and not so savory incidences in the past. But I think we have covered so much of distance in this market that today, 90, I don't want to give a figure because, we are forbidden from giving any data as per the regulations. But majority of disputes between an investor and the AMC are covered under SEBI regulation. You don't have to go to a court, you don't have to go to a police station to file a complaint, and that is something which is the tribute to the market, to the regulator and the players also. Secondly, yes, a lot of things have happened in the past which should not have happened. But again, I'm not trying to defend anything over here. But if you see the statistics, the level of delinquencies that you have seen in the mutual fund in absolute term or percentage terms has been a very small fraction of any other comparable industry. I'm not saying that we are, it's like Doodh ka dhulawa types, we are like, we need to be, crowned as the saints. There's always, there is something somewhere lurking, some risk lurking that we will learn in the future and we will figure out what is to be done. I mean, who thought about what's going to be, something like COVID will happen or 2008 will happen and something like this. So we will all have learning experiences. Now, last but not the least, why the onus is on the investor is because of the regulations. As much as we would like to come and tell you what to buy, what not to buy, as a mandate, whether we are a PMS or an AIF or a mutual fund, the mandate from SEBI is very clear that we have a fiduciary duty, we don't have an advisory duty. And that loophole, the journey between the mutual fund and the advisor has become very big. There are social media, there is Twitter, there is frontline media that is being populated by a lot of people, and people are lazy. Humans have a birthright to be lazy, and nobody wants to read the offer document, nobody wants to read the the information, scheme information documents. They just want to see what's trending on the Twitter and trending on the social media and take that call. So that is where your own responsibility comes from. I mean, everybody knows driving car is fast, is risky, but how many of people follow the rules? So that is why, any amount of, a sort of warning on the dashboard of the car will not help you. It has to come from the self-discipline and sort of constraint that you will have, an abstinence from, bets which are not beyond your risk-reward profile. So this is something which is pretty much the onus on the individual.
Thank you. Any other questions? So thank you very much. Thanks, Jayant, Senior Director, IIFL Securities. Thanks, Mr. Samar Banawat, Executive Director, NSDL. Thanks, Mr. Yogesh Kundani, Senior Vice President, CDSL. Thanks, Mr. Vikram, Fund Manager, Nippon India Life, Asset Management. So with this, we end the third panel, and you can announce.
Yeah. Thank you so much. Thank you so much to all the panelists for joining us. I would request to please come together for a group picture. All right. I request everyone to please join us for lunch.